Hello everyone and welcome to the Stanford Brown SB Talks podcast. Today is Wednesday, June 9th and we are catching up once more with our Chief Investment Officer Ashley Owen to talk various elements of the investment outlook, but primarily about growing fears of inflation and what this means for investment markets, short, medium and long term. Welcome Ashley.
Welcome Vinny and welcome in the world, wherever you are in the world. Nice sunny, warm, balmy Sydney afternoon.
It's balmy as it gets in winter. Excellent.
Balmy as it gets for 8 degrees.
Yes. Thank you, Ashley. So, Ashley, before we dive deep down the rabbit hole of inflation, a brief market update. May saw further steady gains for investment markets, but is it fair to now say that some of the strong momentum we saw post-US election and continue into the early part of this year is now beginning to wane?
Yes, it's true. May was a month where everything was up 1-ish% around the world. Cash, bonds, shares, bonds, all sorts of commodities, etc. were stronger. Not the radical gain. So if you think about, you had a great surge of share prices and everything else since the COVID crisis a year and a bit ago, and then everything's suddenly come back to where it was due to the stimulus and the central bank money printing. And now we're seeing a much more flattened off situation across all markets. And it's very similar to the GFC. We had a massive sell-off in the GFC. Everything rebounded very strongly in the last 9 months of 2009 and then stopped at the end of 2009, started in 2010. Same thing happened in 2011, the big sell-off with the US downgrade crisis, Greece 2 crisis. Everything ramped up very quickly and then came to a stop. Same thing happened again in 2015 with the commodity crisis, and then everything ramped up again in 2016 with the stimulus and then stopped, paused. And the reason for those sort of rapid rebound is different in every case. This time it was the spending, the government spending and deficit spending after the COVID crisis, but the reason for the pause after each of those surges is the same. And that is that people are saying, well, okay, that was good. Now central banks are starting to wind back the stimulus, and the central banks are starting to talk about QE tapering and then even rate rises, which is the same as happened in 2009. So that's the reason for the pause. Biden getting into the White House was good until people realised that's very inflationary, all the spending that he's doing now. So he was spending the original $1.9 trillion, which was the CARES Act replacement for the support payments, and then you had the $2 and a bit trillion infrastructure spending in January, February, and now you've got an extra $8 or $9 trillion of stimulus coming down through the House. So all of that sounds
infrastructure
good.
Packages and other things, education packages.
It sounds good if you say it quickly, but that means that there's far more money going to be in people's pockets and wages, so that's inflationary medium term as well. So the threat of winding back stimulus and winding back money printing and then maybe even raising rates, pretty much every central bank in the world in the last month, apart from Australia, US, UK, Europe, not Japan, they're still dead, New Zealand, Canada, every one of those central banks have now started to say, well, we know we promised you 3 years of zero rates. We're actually going to have to raise rates sometime in the next 12-ish months, and in some cases sometime in the next 6 months. And in some cases, in Canada and New Zealand, it's like the next 6 months of the last half of this year, which we're sitting in 3 weeks. So that's starting to take a lot of the momentum off the share price rally. And also things like the growth stocks and the tech bubble stocks, they're all down.
Been a bit of a rebalance there. I think we've sort of seen banks do well in Australia quite well. Yes. Obviously, commodity prices are and will come too, but there has been a balance back from some of the most speculated areas, almost back into mainstream.
Yep. So all the Teslas of the world, all those sorts of things, the afterpays, all those tech speculative stocks. I say speculative because they don't make any money. Tesla makes money barely.
Speculation towards future profits and future income streams.
So whereas those had a great rally last year, they've come off 5 or 10% this current year. And the cyclical stocks, which tend to do well in economic rebounds, just basic retailers and basic manufacturing stocks, they've done quite well in the last 2 or 3 months. So it's been even though share prices have been pretty much flat, it's been a rebalance between the growth stocks and the defensive stocks, which have come back quite strongly, which is normal in this sort of environment.
Yeah. So you've touched on there, which is probably the main topic of discussion in today's podcast, is really markets are now fixated in terms of where they go from here. What is the outlook for interest rates? And big factor behind that, what is the inflationary outlook? And you've sort of touched on there a number of different regions or economies that might have to raise interest rates much, much sooner than certainly would have been considered 6 or 12 months ago.
Yes.
What are you seeing in terms of your analysis with what's happening for inflation, or what are the big drivers of perhaps central banks now needing to raise rates sooner than had been previously assumed?
Well, there's this great myth or belief that the money printing creates inflation. It doesn't really. The extra money being printed by central banks are sitting in bank reserve accounts, and they're not lending it out. Where they are lending it out, it's to housing, which is a bubble territory pretty much in every country around the world.
And that's probably been the big experience of the last 10 years.
That's right.
A lot of it didn't hit Main Street.
Japan's been trying to print money to create inflation for 30 years, since 1990, and has failed dismally. So the idea of money printing creating inflation only works if people have the money in their pocket and they're spending. Now, that's sitting in two places currently, all that money being printed in the last year in particular. First place it's sitting in is individual bank accounts. So the money supply, which is the sum of all total bank accounts in the world, is like $5 trillion more than it was this time last year. That's all sitting in bank accounts. And that's after all the spending on online purchases last year. The second place it's sitting is, and that probably won't be spent, people are still nervous about their jobs, about the reopening of economies and reopening of borders, so a lot of that money will sit, that $5 trillion will sit
in
there.
offset accounts and other things. Yeah.
Some of it will go to pay debt, but of course at zero interest rates, there's not a lot of incentive for paying off debt. There's incentive to borrow money, which is the idea. And the other place that this huge chunk of trillions of dollars is sitting is in bank reserves accounts ready to lend, and banks aren't going to lend because nobody wants to borrow. Where the borrowing is occurring, it's in private debt markets, bypassing the banks altogether. So a lot of that money is going between
from borrowers
households
that are not mainstream necessarily.
From households straight to corporates via various intermediaries outside the banking system. So
which is quite consistent with the experience. And if you as you talked before about 2010, 2011, when the banks had a lot of the cash in their balance sheet, but not a huge propensity to lend at that time.
Banks in the GFC has been and gone 10, 12 years ago, and the banks were very precarious, and there was a banking systemic crisis which almost was fatal in a lot of cases, and was fatal in some cases. Banks are now, they've got probably twice as much capital per dollar of assets than they had 10 years ago. So banks did not fall over this time like they did last time. They're sitting on massive excess reserves they could lend out, but with zero rates and zero long-term rates as well, very low long-term rates, there's not a lot of incentives, not a lot of margin to play with for bank income. So banks, instead of that, banks have been very active in the takeover markets and the debt capital markets and equity capital markets with all the capital raising. So the banks are making a killing out of fees for capital raisings, debt and equity, and financing, for example, hedge funds and lending to hedge funds. And we've seen a couple of those collapse in the last 2 or 3 months. So that's a much more risky behaviour that banks have had to take on because central banks have kept rates so low for so long. That's in the back of the minds of central banks. So getting back to inflation, what's causing inflation is people are finding it hard to hire people. Workers are scarce. Borders are closed. So farmers, for example, that pick strawberries have to hire Aussies at Aussie wages rather than backpackers at backpacker wages, which is pretty much zero. So those people are hard to find. A lot of friends of mine have got businesses who just simply cannot find staff to fill orders. They've got orders,
retail,
all sorts of things, retailing, manufacturing, supplying, distribution. They just simply can't find staff. So people are charging more for their labour, which is good. They get more money, they spend more money, and that's inflation. That'll take a while to occur. Meanwhile, the other side of inflation is things like bananas and fruit and vegetables, which are partly affected by, and commodities, metals, for example, which are partly affected by border closures, particularly iron ore and coal, and coming down to food as well. So a lot of those items in consumption in the budget for inflation are increasing at pretty galloping rates in some cases. So commodity price inflation, which everything you see around you is made with commodities, and commodities are double-ish the price they were last year, all sorts of raw commodities, and that's feeding through into finished prices, which is feeding through into inflation numbers. So we're seeing inflation run quite strongly in a number of areas, including the US, which is a big one. Now, the US, the Fed's new phrase is transitory. So they're saying, yes, we understand all that, but it's transitory, it'll disappear in time. Part of that's correct, But
there's an element of reflecting what was happening 12 months ago, but that's becoming increasingly less the case now as we move forward.
So if you look at, say, 10-year bond yields, 10-year bond yields, say, whatever it is now, 1.5% to 2%
for Aussie.
In a lot of markets, States, US, Australia, Canada, Europe and Japan are lower, UK. That means that, let's say, a bond yield of 1.5%, that means in 10 years' time, the market expectation is that cash rates are going to be around 1%. Which means inflation is going to be minus 2% if economic growth is, say, 2%. So that's complete nonsense. So if it was a free market in bonds, the bond yield would be around about 3-ish, 4%. What is it now? Less than 2%. So as everyone knows that bond yields must rise over the medium term, and therefore people are getting very nervous about holding bonds, holding long-term fixed assets in portfolios. That's affecting property prices as well. Housing's in a great bubble. But the idea of selling, I saw commercial buildings in Sydney and Melbourne selling on yields of 3-point-something%.
Yeah.
These are office buildings which are half empty, selling on yields of less than 4%, which is just madness. In a normal world, they'll be selling for 5 and 6%, which they always do.
And the messages there, I think, are still that there's multiple bidders coming in quite aggressively for these buildings. So an asset like a long-term commercial building or a shopping centre should be yielding 5 or 6, 7% in Australia, Sydney, Melbourne, Brisbane. They're currently yielding 3s and 4s. If you move the yield from 3s and 4s up to 5s and 6s, that knocks off 10% off the capital value, at least. So everyone knows that. So they're saying, well, in an inflationary world, when inflation returns to 3-4%, or even say 1 or 2%, or above 2%, that's a different skew altogether for asset plus returns in that sort of world versus the world we're in. So if you look at inflation in Australia has gone up and down from 0 to 20% regularly. It was 20% plus in 2021 after the First World War. It was 20+% in the early 50s in the Korean War. It was 10 plus 15% during the mid 70s, and then at the late 70s for different reasons, mainly wars and commodity prices. There were a lot of post-war debt in the economy.
Post-war debt to pay off. So there's a very clear pattern in share market returns around the world and in Australia. It's very simple. In Australia, the broad share market returns around about 10-ish% per annum through the cycle for almost 2 centuries. If you split it between periods where inflation's rising, say 1900 to 1920, 1945 to 1952, 1965 to 1975, 1980, the periods where inflation is rising, shares return pretty much nil after inflation, consistently for decade-long periods. In the period where inflation is falling, in real terms, including dividends, by the way, if you look at the periods between those, the periods where inflation's falling, like it was, for example, between 1920 and 1945, between, say, 1980 and 1997, the periods where inflation's falling, consistently shares return about well into double digits. So if you can split the world into rising inflation periods and falling inflation periods, including the last 20 years we've been in as a falling inflation period, shares return well above average in total terms. In the periods where inflation is rising from a low base like today, looking forward, then you're pretty much guaranteed to get very low or nil real returns from shares after inflation. Now that's
I was going to say that let's unpack that a little bit further, because like anything, everyone ultimately has a choice to make in that environment. Because what you're alluding to is we're realistically heading into a period where inflation's ultra low but rising, and investors have to make a decision between: do I invest in shares? Do I invest in a hard asset such as a shopping centre or a commercial property? Do I buy gold, or do I put it in the bank? And there's a lot of assets there that's going to give a negative real return. As much as a zero real return is not attractive, a negative real return is a very real risk.
Correct. That's including dividends or interest for inflation. So in the last month's report, which is on the website, I go through about a dozen asset classes, including gold, precious metals, bonds, property, shares, etc., for the Australian market looking back a century, and I actually separated into rising inflation periods, falling inflation periods, and then low inflation and high inflation periods. And the patterns are very consistent. Shares perform, the essence of that lesson is, even though the returns are different in each of those types of environments, the ranking of returns doesn't change a lot. even though in the rising inflation environment, shares return lower than they do in the falling inflation, which we've been lucky to have over the last 20 years, but shares still return more than real estate, and in particular bonds and cash after inflation. So if you look at a portfolio, a diversified portfolio today, which might be 50% shares and 30% floating rate and 30% fixed rate and some commercial property, the ranking of returns amongst those assets pretty much stays the same in rising inflation environments, albeit the whole group is lower.
Yeah.
So whereas people, including gold is a lousy returning asset in most of those periods. It's got a couple of spikes every now and again. For example, in 1979-80, it went to records. In 2011, it went to records. But as an inflation hedge, looking through the cycle in all those different periods, it's actually bottom of the list apart from cash. So a well-diversified portfolio today in a falling inflation environment we've been lucky to be in 10 years' time, when we're into a rising inflation environment, I can't see the overall asset allocation being too different at the macro level. You'll still have a chunk of shares, property, bonds,
so that's
etc.
important from a portfolio construction perspective.
Now, within sectors, different sectors will do well, and different regions will do well, but the broad allocation between shares, bonds, property and cash will actually not be a lot different. One of the interesting points in the charts in this month's report was that even though the ranking of returns is very similar across asset classes in each of those environments, property, housing in particular, Sydney, Melbourne, capital city housing, is actually quite stable through all of those. So if you had to pick an asset, which is actually, and Australia is unique in the world, Australia, Canada and Norway are very unique in their demographic structure and our geographic structure, i.e. very few
highly concentrated populations
in diversified industries, which is not unusual.
And certainly probably Canada and Australia has got a reasonable degree of immigration as well.
Immigration and population growth, and Norway's the same. You've got one or two cities and blank space. So you don't try this theory at home if you're an American or British or European or Japanese. It doesn't work. Only in Australia, Canada and Norway does this structure of the economy work in housing. So in the case of Australia, we've been lucky enough to have a rising population, strong migration, very few cities sparsely diversified, but diversified industries, like there are no Detroits. No cities die in Australia. The capital cities, apart I don't really count Adelaide and Perth as capital cities, the big three, Southeast Queensland, Sydney, Melbourne, where most of the population live, that's where immigration heads, and when the borders are open, it'll be back to normal. Population growth, economic growth, those three cities. As it happens,
so you're saying residential property in those cities?
Residential properties close to the CBD, like within 10, 15 k's of the CBD.
So where there's scarcity of land.
Those have done and probably will do in the future perform quite well through all inflationary periods. Shares will return more over the long term through those cycles, but the whole structure of returns does shift up and down as you go through cycles. So you won't see radical changes in portfolios, but just different shapes of portfolios within those sectors.
So that's a good, interesting point you make. I'd like to step back one more to what you alluded to before, which was the rising interest rate space. And we've talked previously on the podcast about Australia's objective of not increasing rates to 2023 to 2024. Where do you think we sit on that? Do you feel that target is achievable? You've previously been quite sceptical about that.
Well, you never trust what the RBA says because it doesn't pretend to be trustworthy. It promised never to do QE and it did. It promised never to do. So you ignore all that stuff. It's all talk. And talk's important because talk's a signal as to what they're thinking next. So talk's not unimportant.
It's managing expectations.
But you don't believe a word of their promises. So they've said that they're targeting 3 years up until the middle of 2024, which is now a couple of years away. And the debate is whether you move that to November 2024 and target the 3-year bond yield that matures then, which they've moved from a fixed, $5 billion a month or $5 billion a week QE asset buying, bond buying program. It's going to be more flexible, we think, in the future, which allows them leeway to scale back.
Yeah.
Whenever there's a bond scare, like a little mini inflation scare like there was in February, the RBA will and has done in February hammer it with sort of twice the QE to try to bring those yields down, and it will do. It's trying to. The government, the RBA is desperate to keep rates low so the government can borrow. It's borrowing probably up to nearly $2 trillion over the next 2 or 3 years. Certainly at least $1.5 trillion in the total lending spree, borrowing spree. the RBA doesn't. If the market for bonds was free and open, the bond yield would be 2 or 3% plus. What is it now? Less than 2% because the RBA is keeping it low. So their job is to keep their the borrowing rates low for their employer. They will start to, I suspect, scale away from QE sooner than we think, because there's no longer any need. S&P, the rating agencies have given the thumbs up in principle to the AAA rating remaining.
Yes.
That's not important because history has shown...
They've upgraded it from negative outlook to
yeah,
stable.
but if you look at the last dozen downgrades for Japan and France and Germany and the US...
The US in particular, their economy, the US dollar surged when they got downgraded.
Correct, and the bond yields fell. So the idea that bond yields will start to rise when the AAA rating is lost is a bit of a furphy, not backed up by history. That's another story. So the point is that if you look at the budget papers for the iron ore price is double or triple what it was in the budget papers. So that looks like staying, and also coal is on a tear as well. So that looks like delivering a bit of a bonus. Pure luck. It's just pure luck that the dam closed in Brazil in 2019 and the border's been closed ever since. So it's pure luck that the iron ore miners and the government treasury have done very well out of that crisis in coal and in iron ore particularly. So I suspect, relative to other countries, Australia's a low-debt country still. Great capacity to borrow, as long as the borrowing's on sensible, productive things, like most of it will be. The government will keep its AAA credit rating, or if it loses a notch, then it won't make a difference to the bond yields, like it hasn't in the past, for most countries. And cash rates will start to rise more than likely within a year. I suspect we'll see cash rates in Australia rise.
So I think the key to a lot of this, and again, similar to what you talked about before, being like the US QE tapering and other things, is going to be about managing market expectations of what's going to happen next. And obviously expectations are currently being managed to have ultra low interest rates for a long period of time. That's going to probably taper in a bit. And it's just going to be a question of how well they can manage that message. And because there's the risk of like the late 2018 US market sell-off when the expectations suddenly changed overnight. Now they backtracked from that and brought the market back in line, but that's probably one of our key threats.
There'll be lots of QE taper scares. Remember Bernanke's first taper scare in May 2012?
We went from modest to moderate tapering.
That's right. Yeah. So 2012, same thing in 2013, same thing in late 2016, same thing in 2017, same thing twice in 2018. This idea that rates will rise and therefore everyone drops everything and runs for the hills. That'll occur regularly. They're short term, and we don't worry too much about those, and that will be an occasional scare from time to time. Rates will rise. I mean, this time in 5 years' time, rates will be a lot higher. How they get there, when they get there, it won't be in one big jump. It'll be a steady. Now, the Fed could well act too late and too fast. If you can understand, they wait too long, and then when they do wait, they say, well, hang on, I've got to get...
They get behind the inflation curve.
So they start to do it. So in 2018, the Fed raised rates 5 times from December 17 to December 18, and the market tanked 25% around the world, including Australia. Then he woke up on Christmas Eve and said, I got that wrong. And he started going reverse. So that's going to happen regularly over the next 5 years. So we have to get used to it like we have over the last 5 years, since 2012 onwards. So that's just part of the landscape. You learn to ignore the noise and focus on company earnings and company profits and dividends.
Now, just take a slight step change. You wrote one piece in our latest monthly also about Australia graduating from its Banana Republic status, a celebration.
Yes, this is
coming of age.
Australia being a young, post-settlement Australia is a young country built by imported people with imported capital, as all emerging markets are. The US was an emerging market for 400 years and then became a... It's... The term developed world versus developing versus emerging, there's lots of definitions. The most definitions relate to income per capita, not median, average, so the billionaires boost the average, even though that make no difference to the workers. If you look at, there's two sorts of countries in the world. There are those countries and households that lend money to the rest of the society, and those that borrow. So in individuals, there's borrowers and lenders. In countries, there's borrowers and lenders. Australia has always been a net borrower. We've always had bigger ideas and opportunities than we have had savings pools and people. So it's always, as all growing emerging markets have been. US turned from a borrower, an emerging market borrower, an agrarian town-based economy in the 19th century into a lender by the start of the the 20th century and the start of the First World War. So they emerged into a industrial powerhouse. Germany did the same post-war. China took about 20 years to go from a borrowing country in the late 70s, and Deng Xiaoping's reforms turned it into a great lending country, a surplus country lending to the world like it is now. And that all occurred in about 2 decades. Some countries have never emerged and will never emerge, probably. You look at all of South America, all of Latin America, they've been emerging net borrowers for centuries. India still is after 5 centuries of British rule and independence. So some countries will never emerge for a whole lot of political and structural reasons. Australia has always been a borrowing country that's always sucked in capital from overseas to fund our lifestyles. Over the last 2 or 3 years, we've had this tremendous iron ore coal boom, which meant our exports have boomed. We've had these great trade surpluses, which we do have from time to time. But the trade surpluses we have from time to time are always offset by massive borrowings. So our interest on foreign debt always exceeds the interest we earn on debt we've lent other people. So yes, the trade surplus has been good over the last few years, but that's hiding the real story. The real story is the fact that Australia's investment pool, our superannuation pool,
superannuation bucket,
over the past has been more foreign investment into Australia to fund things like things we see around us, building infrastructure, housing. That's all. The banks basically are a conduit for foreign debt for households in Australia. So over the hidden line in all the current account surplus is that whereas Australia always has had a net deficit on the income on our foreign debt, i.e. we pay more in foreign debt interest than we receive, this year, next year, we'll see our savings pool, i.e. our investment now in our portfolios. 10 years ago, Aussies didn't really invest much overseas. It was a bit foreign, it was a bit different. They didn't understand all these funny names, companies. Now, our portfolios, we have more global shares, foreign shares in our portfolios than we do Aussie shares. The Futures Fund in Australia has got 2/3 of their allocation to foreign shares. So Australians as a group, as investors, are now investing more overseas than foreigners are investing in Australia. And that's been a very slow thing. It's occurred over the last 20 or 30 years, and that's the reason we are now going to be net lenders to the world. It's like a child who's always relying on mum and dad's money. We are now a child that's grown up, and we now contribute to the world and have the capacity in the savings pool to lend overseas. So it's quite a difference. So in that way, we've gone from being, we're about to go from being a banana republic, i.e. relying on commodity prices, and into a mature economy where we're actually net savers, and we can then lend our savings to the world to invest in other countries. It's quite a different, it's like the US did 120 years ago.
Yeah. And over the next few weeks, we reach the end of financial year, end of next quarter, begin to revisit the allocations again.
Get the dartboard out.
Have you dusted off the crystal ball just yet?
I haven't. I normally do that at the end of each quarter. We were quite bearish on shares, both our global models and our Aussie models, at the end of last quarter, end of March. We did not underweight shares because we could see that the ability of the central banks to keep rates low for longer was still more powerful than the overpricing of shares, and that worked because share prices have drifted up around the world and in Australia 3, 4, 5% over the last quarter. When we sit down again at the end of June, there's a few more moving parts. All central banks pretty much are now preparing the market for an earlier than expected QE tapering and an early expected rise in rates. That's changed. It's a bit of a change on the horizon. Whether that turns into reality depends on a lot of things, but at least they're talking about it now.
Again, expectations management.
Correct. So there's a couple of things different. Meanwhile, the borders are still closed. Every time somebody gets a cold in Melbourne, they close a whole 6 million population down. So that's still causing a lot of problems. Yeah. The international travel is still off the cards for anybody. Interstate travel is hairy at the best of times. So those sort of activities upset company revenues and earnings and hiring and people spending money. So that's still around and probably will be around for many, many months to come. We don't know. So that's a negative. Meanwhile, people are still buying online. There's still $5 trillion in household savings sitting there waiting to be spent, and that's being spent. So there's a lot of moving parts more than just the normal, are shares expensive or not? And we'll look at those again. We'll tell you all about that in a month's time.
Excellent. We'll look forward to it. Thank you very much, Ashley.
Thank you all.
And thank you, everyone, for listening.
Fantastic.